what would be the ratio of that hedge versus play? That's really up to you. It depends on how much, that you have at risk, how much you want to protect. Typically, I won't spend more than, say, on average, maybe 10%, 10 to 15% at the most. So if I've got, say, $3,000 in one direction and I want to hedge, maybe I'll spend about $300 on that hedge. Because if I can get, let's say if I can get a triple out of the hedge, if it really works for me, and I make $900, and then this ends up not working. So I end up losing, let's say I lose half of it. I lose $1,500, but then I got a $900 hedge. What did I lose? I only lost $600, which means if you look at what I lost 20% of my initial trade. The short term is the hedge is always short-term duration. Always. Because otherwise it becomes too expensive. If you go out to March with a hedge, you're going to pay so much more money that it doesn't make sense. It might start to make a little bit of money, but it won't make anywhere near what you paid for it, plus the cost of your original trade. No, you can't go out 2 weeks. Why would you go out 2 weeks? If you're hedging an event, in other words, we know that Wednesday is NVIDIA Day. So on Wednesday, I'm going to put a little hedge on for Friday in case NVIDIA, I wake up Thursday morning, NVIDIA is like, bang, like this. I'm going to cash out here, right? And then on a pullback, I'll ease out of my short positions. That's usually the idea. Unless it pops and drops. If it pops and starts to drop, I could take my money off the hedge right away and stay in my longer term short. So this is covered specifically in the 10 musts to master. Again, I'm always referencing that video section under the Nugget Farm for those of you that have been through the entire basics and advanced curriculum. If you've been through all of those, you have an active trade tracker. You've been tracking the trades, not trading live. Good boy, good girl. Then you can go to the 10 musts to master. And I cover pretty much every question that you guys have asked so far. Pricing, strategy, cost of options, lowering the cost of options, when to hedge, how much to hedge, how far out do I hedge, when should I not hedge? It's all covered, but you do it, in order. Always in this order is the way it works best. See what other questions you have. Are you going to make enough on the hedge to significantly make up the loss in the original position? No, not necessarily. You'll make some money on the hedge. The idea, Art, since you don't know this, but you will find this out soon, is one of the things that we teach here is allocation. And I don't mean 2% of your account, 5% of your account. I mean a very, very specific allocation that is personal to you. How to add to the position, when to take it off, and all of that. Very, very specific. It's all part of a specific trading plan that unless you go through all the material, you won't have. So if you do this correctly and you have a pilot position, the pilot position is actually less than your burn. Your burn level is the amount of money that you can afford to lose in any given trade. Pilot position is even less than that. And then we have a strategy that has you exit the trade if that pilot position gets down by 70%. So then you really only lose 70% of the pilot, which is less than the burn, which you already said you're okay losing. Certainly if you have a 70% win rate, you could afford to lose a certain amount of money on any given trade. But you don't have to lose that amount. You'll lose only the pilot. Oops, not even that. You'll only lose 70%. So if I add a hedge, and that hedge can bring me in some money, that now whittles away at this number. It doesn't have to completely or significantly make up for the loss. I've already accounted for the loss. I'm perfectly fine. My equity curve looks like this for 6 years. So I'm okay losing 70% of an initial pilot position. If I add a hedge, then it's even less than that. Maybe it's 40%. And that's freaking gold. Because if my equity curve looks like this, losing 70% on trades that don't work, wow. Yeah, so I think Nike's going to be okay. Wasn't able to take the money off here because it happened so fast. So the best way to look at the Nike trade is if you break the daily 20, then just exit the trade. If it stays here and continues to move, then those 65 calls will be great. So my goal, I used to have, and I got to go, I used to have a hedge philosophy to make back a certain amount. But then I keep reminding myself that if I trade within my pilot position, and I know I'm going to, even if I risk the entire debit of the pilot, I know that I'm okay because of my win rate and my ability to manage, roll trades, add to trades, hedge trades, and all of that. So I know I'm good, right? With the plan that I have. So now, if I add a hedge, I used to want to make up back a certain percentage of the pilot that I'm going to lose. But now, for me, it's any amount. If I can make, and it'll be based on what the markets do. If the markets go through the roof and the hedge I make a lot of money from the hedge, I'm happy. If it just pops a little bit and then I have to take it off and I make a little bit, I'm happy. If it goes nowhere and I close it at break even or it loses, I'm happy. And if it doesn't work at all, I know I'm happy. Why? Because that means this trade is working. So I don't necessarily feel like I have to make a certain amount of money back on my hedge. I'm just looking to have it as a little bit of just an edge against a direction.
Thanks for watching. Hope you enjoyed this video from Trade With Me Now. Make sure to go ahead and like this video and subscribe to our channel so you make sure that you catch our next video right when it's released. Also, if you have a question or comment, please leave that in the comments section below. And of course, if you want to learn more about Trade With Me Now or join our community of profitable traders, go to tradewithmenow.com. There's also a link in the description below.